Hi everyone, welcome back. So we are continuing with the blue view. So as you can see, I'm still wearing the same outfit from part one. Haven't changed my substance. Doesn't look like I have much time, but I'll take on the challenge and allow it to turn blue if it must. But I'm basically filming this right off of filming that previous episode. So welcome back. Okay, so we're featuring SARS. Remember, our nugget is consider SARS from the start. And what are the considerations that you should make, right? Firstly, I want to just cover some misconceptions, right? Because when someone starts thinking about, I want to start this business, they think that they have to register the business with the CIPC. And it's not always the case, right? So we have a very big informal sector in South Africa. It's huge. And if you are the only owner of your business, right, you have 100% of the rights to all the profit that you make. You are a sole proprietor. Or if I bring on my buddy and we work on something together, we make a partnership. And even that doesn't have to be registered with the CIPC. But like we mentioned in the previous session or in part one, there is no reality that exists where you can make money and not tell SARS about it, right? There is a reality where you do make money but don't owe SARS anything. That's where the tax thresholds come into play. So they're split into three groups rather, for those that are aged 65 and below, for those that are aged between 65 and 75, and for those that are aged 75 and above, meaning you do not have to pay tax. You don't need to pay SARS tax until you start making that amount of money, right? So like we mentioned previously, you don't want to earn money and wait for that threshold before you start creating a cash flow for what you potentially would then owe SARS past that threshold. Wisdom says just create a savings account. It's your money in any case, right? And if it never works and goes to SARS, it still benefits you. And if ever SARS comes back and you do actually need to pay SARS something, you have something, right, to pay SARS. You have cash flow, and cash is king. So I think for me, the blue nugget is still the same going into this session. And we are basically saying, make sure you give to Caesar what belongs to Caesar, or you're in the position to. While then the other misconception is that tax only applies when one is employed or when one registers a company with the CIPC, right? So what happens if you don't fall into either of the buckets? What if you're part of the informal sector, which is huge in SA, meaning you're not registered with the CIPC, but at the same time, you're not employed, formally employed, because there's definitions to that. And that creates a bit of a blind spot or a false sense of security. For those who like taking risks, like I said, you could get away with not being compliant, possibly all your life. I'm sure there's plenty of people who just run a cash business. They maybe put money under the couch, or you have a safe in the house. There's different ways of trying to cheat the system, right? And like I said, I would never encourage that. This is not the platform for that. But you could create a blind spot for yourself or a false sense of security, thinking, I'm not seen, I'm not known by anyone. And if you don't use a bank account, maybe you do use a bank account, whatever the case may be, but I would advise against it. Rather live in the house that we are building, right? Where it's in order and these nuggets live there. And the other blind spot that can be created by these misconceptions is that if I'm formally employed rather than not being employed and I start a side hustle, I don't need to declare that side hustle to anyone. Oh, sorry, my watch. Hence I took it off. Sorry about that beeping sound. Background noise, my watch. So you start a side hustle. It's hardly making you money. If anything, you are putting money from your main income into that side hustle. You're hardly actually making money, which is the reality for a lot of people that are starting up, right? And you think you don't need to tell SARS about the side hustle. And the reality is it's easy to not do it, not because you're trying to hide or you're trying to not be compliant. It's just, it's admin, and maybe you're just not even thinking about it. You are just hustling and you're trying to survive. And at the same time, you can't afford to hire an accountant or someone to make sure that that house is in order as you're building it. And also, maybe you're just not even sure if it will survive in long enough for you to even owe SARS anything. So why bother, right? Which, these are reasonable considerations, but I would still say, even if that side hustle is making £0, right? Start thinking about SARS, start thinking about tax, start having certain disciplines of keeping documentation. Or if you are borrowing money into that business, document it somewhere, right? And I'm also preaching to myself here. And then the other blind spot that is created is you registering a business as a means of you actually starting a business. It's like the first thing you just go to CIPC. And CIPC is like your dream, and attached to CIPC is like your shadow that we spoke about before, that's attached to it. Like the moment you go to CIPC, you have a tax number, which could be good for admin in terms of making sure that you actually are conscious of there being a SARS that you might need to pay. But in terms of admin, CIPC requires additional disclosures and submissions from you that a lot of people might not necessarily be familiar with. And people then tend to be advised to find an accountant, or they feel like they actually need to find an accountant that will help them either in crisis mode, because now things are due and you are at risk of being deregistered or whatever the case may be, and now you have to pay someone who's going to charge you money that your side hustle doesn't have. So I would say, to avoid that runaround, first consider what kind of registration is required, if any, before you actually start with the CIPC. Like we said in the previous episode, you would need to register, or actually if you are a sole proprietor or a partnership, you do not need to register ever. Actually, there's no time limit with the CIPC, but you do need to declare income with SARS. As an individual, your income is your business's, rather, your business's income is your income. It's considered that way. So you are your business is you, and you're taxed as one. So you cannot necessarily separate yourself from the business. But the moment you want to separate yourself from your business and you want your business to be its own legal entity, meaning it has to answer for itself, right? It owes its own debts. They don't become your debts, and you might be able to then gain capital from shareholders, and they then start to own part of your business. So now you're no longer the sole owner of that business, and then you're required to actually register a company, because now you technically are a company, or you meet the requirements of registering a company, private company in most cases. But the structure is one of you not being the sole owner of your business. So rather take on some nuggets, spend a small amount of money consulting with a tax practitioner from time to time, or searching out videos from SARS, or going to a SARS branch if you have certain questions, so that you can get your house in order and not find yourself in a hot mess, right? So there are certain things that you consider when it comes to tax, or that affect tax. We just spoke about the first one that I wanted to cover, the type of business that you're dealing with, right? So depending on the type of business that you have, there are some deductions that might be applicable, some that might not. As an example, if you pay yourself money, or you take money from your business, because you are your business and your business is you if you're a sole proprietor, even a partnership, right? So your partnership could be trading, but that net profit that you have a share in is still taxed as your income as the individual, right? And if you then take money out of the business, SARS says, wait, that's still your money. You don't get a deduction for that. Versus if a company that you started pays you a salary, that legal entity will get a deduction, but you will never get deduction for money that's coming to you as a salary. You can't claim that as a deduction against yourself. That's what I'm trying to say. Obviously, you can get other deductions against that said income that you have declared as your income. So the type of business is important to know who gets the deduction and what kind of deduction you can get, because deductions vary from individuals versus companies, what's allowed. And then, are you considered an employee or an independent contractor? So you could have followed all the requirements of the CIPC, registered a separate business, you invoice people as opposed to getting a payslip. But SARS could be like, no, actually, you're an employee, technically, right? Because South African law looks at the nature of the agreement and not the contract itself. So the contract could just say, you're a service provider and I am your client. That's the nature of the relationship. But the substance of the relationship is one of employee-employer, if certain requirements are met, that we'll quickly cover here. What that affects is who then pays tax to SARS. Is it the employer or employee? Employee. So generally speaking, the burden of proof rests with the employer. They are the ones that have to say, this is my employee, or prove that this is not my employee. And if you're an employer, you have to abide by certain rules. You have to be paying UIF for employees. There's certain rules or legislation that applies for an employer if they have employees, or a person that has employees. And one of those requirements is to pay tax on behalf of that employee, to withhold tax. Even if you get an invoice to say you owe a person, if that person is deemed an employee by SARS, you have to withhold tax from the invoice amount, right? And you'd have to calculate how much you have to withhold. Versus if this person actually qualifies as an independent contractor, then they are responsible for their own taxes, and they can pay tax. Also, in terms of intervals, they can possibly register for provisional tax and pay tax biannually as opposed to monthly if you're an employee and you fall under the PAYE regulations. So the last thing to consider is tax relief in the form of deductions. Like I said, getting your house in order, making sure that you know what you qualify for. You're keeping documents that are valid according to SARS. That would not result in SARS disputing that you actually qualify for that deduction. So knowing that, you need to consider what is it that I can actually get a deduction for, and make sure that you have everything in order to be able to claim that deduction. I just want to, as we close off this part of the discussion, I just want to go through the different indicators that are considered when determining employment. From a Labor Relations Act point of view, the indicators are control. Some of these are actually quite similar to the SARS factors. So control, the manner or hours of work subject to direction by another person or organization. Are you being told what to do, or are you determining what is required? Integration, the person forms part of the organization versus, someone who just visits from time to time or comes on request. You don't induct that person generally to be part of your organization. Economic dependence, is the person economically dependent on the other for their livelihood? Generally speaking, if you're employed, if your employer shuts down, you're unemployed. Versus if that company shuts down and they're one of your clients, you could be impacted, but if you do not form part of an employee, technically speaking, according to this definition, you should be okay, even if that client closes down, because you should have other clients that take up a lot of your time. Tools of trade, the other person provides tools or equipment. Your computer, is it a work laptop or is it your own laptop? As an example, it's a very easy indication. Or if you are a plumber, do you have your own equipment that you own, or do you arrive in a building or at a place and you're given equipment to say, go work in that house? You get directed and told to go work in a particular place. Your tools of your trade are your own or they belong to the other. Exclusivity, the person works for or renders services to only one person or organization. Okay, duration, worked for an average of at least 40 hours per month over the last 3 months. Right, then you are considered an employee if you've worked there. So even if you are a temp, it's quite important. If you're a temp and you go to the same place every single day or regularly enough that you cover at least 40 hours on average per month, over 3 months, you then qualify as an employee and should be entitled to certain rights as an employee. Right, so a temp or a short-term contract has to be careful to not exceed this 3-month period. Otherwise, you have an employee on your hands. Presumption of an employee. If any of these factors are present, a person is presumed to be an employee. An employer must prove the relationship is not employment, i.e. is therefore an independent contractor, and therefore they are not responsible for a few things that an employer would be responsible for, including, for tax purposes, paying over the tax. And an employee is subject to control, works for another, receives benefits, leave, overtime, etc., is part of an organization. In summary, an independent contractor operates independently, controls their own work, typically for a specific project, and bears business risk like poor performance, right? And we mentioned this, South African law looks beyond the contract's name to the reality of the working relationship. The source for this is Google, AI. I like that summary. So I think there's a few websites that might be linked or giving us these definitions. And then SARS definition for tax purposes, they see if you're an employee, therefore PAYE applies, or you're a contractor and you have to pay your own taxes. So they look at statutory tests. There are 2 of them. They apply if common law is you're not an employee according to common law. Control or supervision test, meaning how, when, where, work is done is above 50% at the place or at the client's premises, right? And the 80-20 rule says one client provides more than 80% of the income that the independent contractor earns, and you do not employ more than 3 full-time employees or staff, excluding relatives, because this is an and test, right? It says you should be getting more than 80% of your income from said client and you don't employ. So I think if one fails, I think then you don't meet that. Common law, dominant impression, considers the overall relationship. So this is where you first start before you go to the 2 statutory tests. They look at, similar to the Labor Relations Act, control, who controls the work. Integration, how integrated are you into the business? Economic reality, do you use your own tools or premises? Do you risk profit or loss? And provisions, entitlement to leave, benefits, single versus multiple clients, etc., etc. So similar characteristics or factors. So your rights are determined under the Labor Relations Act if you're an employee. And then for SARS purposes, SARS is just saying, are you paying me every month or are you paying me every 6 months? And they'll penalize you if you make the wrong classification of who you are. Are you an employee or a independent contractor? An individual might have labor rights as an employee but be taxed as a contractor, or vice versa, under specific conditions. For today, I think this video has been long enough. I think we'll wrap it up here and we'll resume when we go through our cause and effect analysis. Take care. Bye.